So, good afternoon, everyone. So, we are from Group 3 and we are assigned to discuss the summarizing phase of accounting process. So, next, adjusting entries. So, what do you think is adjusting entry? So, an adjusting entry is an entry made to assign the right amount of revenue and expenses to each accounting period. So, adjusting journal entries are used to record transactions that have occurred but have not yet been appropriately recorded in accordance with the accrual method of accounting. So, it updates previously recorded journal entries so that the financial statements at the end of the year are accurate and up to date. So adjusting journal entries are recorded in a company's general ledger at the end of an accounting period to abide by the matching and revenue recognition principles. So an adjusting journal entries can also refer to financial reporting that corrects a mistake made previously in the accounting period. So most companies that use cash accounting do not need to make an adjusting journal entries. Next.
Good day, everyone. I am Ryan Señoron, and let's talk about understanding adjusting journal entries. The purpose of adjusting entries is to convert cash transactions into accrual accounting method. Accrual accounting is based on the revenue recognition principle that seeks to recognize revenue in the period in which it was earned, rather than the period in which cash is received. When you have adjusting entries, you're recording business's transaction accurately in time. And this extremely helpful in keeping track of your receivable and payables, as well as identifying the exact profit and loss of the businesses at the end of the fiscal year. So if you create financial statement without taking adjusting entries into consideration, the financial health of your business will be completely distorted. Well, the income and the owner's equity will be overstated, while the expenses and the liabilities understated. That's why using the accrual basis and adjusting entries is so important and recommended by accounting and tax experts.
So, for example, a company that has a fiscal year ending So, for example, a company that has a fiscal year ending December 31 takes out a loan from the bank on December 1. The terms of the loan indicate that interest payments are to be made every 3 months. In this case, the company's first interest payment is to be made March 1. However, the company still needs to accrue interest expenses for the months of December, January, and February.
Example number 2. Since the firm is set to release its year-end financial statements in January, an adjusting entry is needed to reflect the accrued interest expense for December. To accurately report the company's operations and profitability, the accrued interest expense must be recorded on the December income statement. And the liability for the interest payable must be reported on the December balance sheet. The adjusting entry will be debit interest expense and credit interest payable for amount of interest from December 1 to December 31.
So let's proceed to the next reporter.
Okay, good afternoon, everyone. So, this is our report in accounting. Our topic for today is all about accrual method of income and expenses. So, accrual basis accounting is one of the two leading accounting methods and the preferred bookkeeping method for providing an accurate financial picture of a company's business operations. So accrual basis accounting recognizes business revenue and matching expenses when they are generated, not when the money actually changes hands. This means companies record revenue when it is earned, not when the company collects the money. It is also means recognizing expenses when the company incurs the liability for them, not What is accrual basis accounting? Accrual basis accounting combines two key accounting principles: the matching principle and the revenue recognition principle. The matching principle says that expenses should be recognized in the same period as the revenue they help generate. The revenue recognition principle states that the revenue should be recognized when it is earned or realized. When a business performs the actions that entitles it to the revenue. So what is accrual basis accounting? So again, accrual accounting generally makes the relationships between revenue and expenses clearer, providing better insights into profitability. It also offers a more accurate picture of a company's assets and liabilities on its balance sheet. For these reasons, accrual basis accounting is the only method allowed under general accepted accounting principles or GAAP, and it is required by the Securities of Exchange Commission or SEC for publicly traded companies. Next slide. So how does accrual accounting work? So in accrual accounting, a company recognizes revenue during the period it is earned and recognizes expenses when they are incurred. This is often before or sometimes after it actually receives or dispenses money. So accrual accounting works by recording accruals on a balance sheet that act like placeholders for cash events. For examples, account receivable is an asset account that reflects revenue a company has earned but hasn't yet been paid for. Similarly, accounts payable. It is liability account that reflects amounts the businesses owes but hasn't yet paid. So examples of accrual accounting is next slide. So this is the revenue example. So a simple example of accrual accounting for revenue is when a company makes a sale to a customer on trade credit, meaning the buyer pays the seller within a set period of time after the transaction. In this case, revenue is earned before cash is received, primarily when goods change hands or service has been performed. So another is Tom Service delivered IT services worth $5,000 to customer Smith Computers on February 10. Tom Services sends Smith Computers a bill when it produces invoices at the end of the month on February 28, and if you're using a cloud-based accounting system, the revenue is recognized when a transaction is recorded. So Tom's Services invoice terms require payment within 30 days. So Smith Computer sends a check to Tom's on March 15, which is deposited the same day by the Services Inc. Here are Tom's Services accounts receivable and cash journal entries for this transaction. Next slide. So, di man siya makaro. So, muna siya for the February and for the March. So expenses example. A common example of accrual accounting for expenses is when a company buys inventory on credit. So this is example. Sports World, a sporting goods store, receives $5,000 worth of soccer balls from manufacturer soccer experts on March 1 and stocks them on its shelves in advance for the soccer season. Sports World receives an invoice from soccer experts on April 5, which it pays on April 10. So here, diri gisendan March, then diri sila nag-pay, I mean, yeah, sa April na. Okay, next slide.
So let's proceed to the other examples. So there are many other ways revenue and expenses are recognized with accrual accounting. A fewer other use cases. If annual or multi-year contracts, membership or subscriptions are paid in a single lump sum, the revenue or expense is spread across multiple periods over the life of the contract and subscription. For payroll, vacation, or employee benefits that accumulate between payroll cycles, the company recognizes each expense during the period it applies to, even though it pays the expense later. Then, when utilities or rent are billed after the period to which they apply, the company accrues the expense during the period that it uses the utilities or rented property. For income tax or sales tax due on revenue, the company recognizes the tax during the same period it recognized the revenue, even though it pays the tax when required by IRS. So interest on loans is recorded during the period the principal is outstanding, even though it is paid at later date. Next. So when to use accrual basis accounting? The accounting must be used for any regulatory filing that requires GAAP, such as a company annual 10K filing to the SEC. Most investors, lenders, and financial institutions requires GAAP financial statements when evaluating a business, which is a major reason why accrual accounting is more popular method. However, a few exceptions do exist, largely around income taxes. The Internal Revenue Service allows small businesses with less than 25 million US dollar in annual revenue to use either accrual or cash basis accounting. Sole proprietorship, partnership, and S corps are also allowed to use cash accounting. Note that changing your accounting method requires additional filing requirements with the IRS. So, it says that accrual basis accounting is used when a company wants to record financial transactions based on the occurrence of economic events, regardless of the timing of cash flows. So this method is suitable for businesses that extend credit to customers or receive credit from suppliers. So it is as it allows for the recognition of revenue and expenses when they are earned or incurred, rather than when cash is exchanged. So it provides more accurate presentation of a company's financial position and performance by matching revenues with the expenses they generate. Accrual basis accounting is required for publicly traded companies and is generally considered more comprehensive and transparent than the cash basis accounting. It is particularly useful in measuring long-term financial stability, facilitating comparisons across different accounting periods, and adhering to generally accepted accounting principles. Next. So, advantage of accrual accounting. Accrual accounting is preferred method of accounting for most businesses because it offers a more accurate presentation of a company finances. Investors and lenders may require this method, and even if they don't, the consistency of K with Rizz could make your business look more stable, and increase the chance to receiving funding. Additionally, accrual accounting makes your GAAP complaint, which is best practice and could become important down the line. So, accrual accounting offers several advantages over cash basis accounting. Firstly, it provides more accurate depiction of a company financial performance and position by matching revenues with the expenses they generate. Then, this enables better decision making and assessment of profitability. Next will be accrual accounting allows for more comprehensive and transparent representation of a company's financial activities as it recognizes transactions when they occur. Regardless of cash flows timings, then facilitates better financial analysis planning and forecasting. Additionally, accrual accounting aligns with the general accepted accounting principles and is required for publicly traded companies, ensuring company compliance and regulatory standards. Next. So the question is accrual accounting right for your business? So if your business relies entirely on cash payments, both for revenue and for expenses, the accrual accounting may not be right for your business. For most other businesses, those that extend credit to customers or use credit with their suppliers, accrual accounting gives more accurate picture for their overall financial health. In general, the greater the lag in payment time, the stronger the argument for accrual-based accounting. Products-based businesses that carry inventory, even if they're small, usually use accrual accounting because a cash method doesn't properly account for cost of goods sold and sink gross profit. So determining whether accrual accounting is right for a business depends on its specific circumstances. Generally, accrual accounting is recommended for businesses that extend credit to customers or receive credit from suppliers, as it provides a more accurate reflections of financial performance and position. It is particularly beneficial for businesses that require comprehensive financial reporting, need to comply with regulatory standards, or seek to analyze their long-term financial stability. Next. So, how does accounting software help with accrual-based accounting? One of the biggest reasons businesses hesitate to use accrual accounting is the time and effort required to maintain the books and records. So it is more complex to manage accounts receivable, accounts payable, and prepaid or deferred assets than to simply track cash ins and cash outs under the cash basis method. Additionally, the accrual method requires company to close the books or frequently monthly rather than annually. Further, companies generally manage subsidiary ledgers like accounts receivable and accounts payable more frequently on on a weekly or biweekly basis. So, accounting software greatly aids in accrual-based accounting by automating and streamlining various processes. It enables businesses to easily record and track accruals such as accounts receivable and accounts payable, ensuring accurate recognition of revenues and expenses. The software generates financial statements and reports that reflect the accrual basis, making it easier to analyze the financial health of the business and adhere to regulatory requirements. Next. Next po palihog. And yeah, that's all for about the accrual business accounting. Thank you.
Good day, everyone. So we are going to tackle today about the accrual method of income and expenses. So what is accrual method? So under an accrual method of accounting, you generally report income in the year it is earned and deduct or capitalize expenses in the year incurred. So the purpose of an accrual method of accounting is to match income and expenses in the correct year. So accrual basis accounting is one of two leading accounting methods and the preferred bookkeeping method for providing an accurate financial picture of a company's business operations. Accrual basis accounting recognizes business revenue and matching expenses when they are generated, not when money actually changes hands. So this means companies record revenue when it is earned, not when the company collects the money. So it also means recognizing expenses when the company incurs the liability. So accrual basis accounting creates a more accurate view of a company's financial status by recording revenue when it is earned and expenses when they are incurred. So effectively matching revenue with expense. So under this method, companies record revenue and expenses using balance sheet accounts like accounts receivable, accounts payable, prepaid assets, and accrued expenses. So what is really the accrual basis accounting? So it makes the relationship between the income and expenses clearer. It provides better insights of the profitability of the company. It will also offer a more accurate picture or illustration of a company's assets and liabilities on its balance sheet. So for these reasons, accrual basis accounting is the only method allowed under General Accepted Accounting Principles or the GAAP. And it is required by the SEC, or this is the Securities and Exchange Commission, for publicly traded companies. How does it work? So how do you put this on the sheet? So accrual accounting works by recording accruals on the balance sheet that act like placeholders for cash events. For example, for the accounts receivable, it is an asset account that reflects revenue a company has earned but hasn't yet been paid for. So similarly, accounts payable is a liability account that reflects amounts the business owes but hasn't yet paid.
So revenue example. A simple example of accrual accounting for revenue is when a company makes a sale to customer on trade credit, meaning the buyer pays the seller within a set period of time after the transaction. In this case, revenue is earned before cash is received, primarily when goods change hands or a service has been performed. So examples of accrual accounting. Tom's Services delivered IT services worth $5,000 to customer Smith's Computers on February 10. Tom's Services sends Smith's Computers a bill when it produces invoices at the end of that month. On February 28, and if you're using a cloud-based accounting system, the revenue is recognized when the transaction is recorded. So Tom Services invoice terms require payment within 30 days. Smith's Computer sends a check to Tom's on March 15, which is deposited the same day by Services Incorporation. So here are Tom's Services accounts receivable and cash journal entries for this transaction. So on February, accounts receivable of Smith's Computer, so the debit is $5,000, so the revenue is $5,000. And on March, the cash and the debit is $5,000, so the account receivable of Smith's Computers is $5,000. So the expenses example. A common example of accrual accounting for expenses is when a company buys inventory on credit. So Sports World, a sporting goods store, receives $5,000 worth of soccer balls from manufacturer soccer experts on March 1 and stocks them on its shelves in advance of the soccer season. Sports World received an invoice from the soccer experts on April 5, which is paid on April 10. So the Sports World accounts payable and cash journal entries for this transaction are, so the debit on March is $5,000 of the inventory soccer balls. So the accounts payables of the soccer experts is also $5,000. On April, the debit is $5,000 and accounts payable of the soccer experts, so the cash is also $5,000.
I am Sarah J. Milla together with Jhe Petallar, and we will be discussing about the types of business organization. The first type of business organization is sole proprietorship. It is an unincorporated business that one person owns and manages, as the business and the owner are not legally separated. And sole proprietorship, it is the simplest form of business structure. It is also known as individual entrepreneurship. It is also sole trader or simply proprietorship. It is a business that can be owned and controlled by an individual, a company, or a limited liability partnership. There are no partners in the business. The purpose of sole proprietorship is that it allows small business owners to begin a business without taking formal legal action through the state. The second one is partnership. A partnership is an arrangement between two or more people to oversee business operations and share its profits and liabilities. In a general partnership company, all members share both profits and liabilities. Professionals like doctors and lawyers often form a limited liability partnership. The purpose of partnership is to establish a business enterprise through a legally binding contract between two or more individuals or other legal entities. This partnership agreement designates the rights and responsibilities of each partner or entity involved.
Corporations. A corporation is legally a separate and a distinct entity from its owners. Corporation possesses many of the same legal rights and responsibilities as individuals. Almost all large businesses are corporations, including Microsoft corporations, the Coca-Cola corporations, and Toyota Motor corporations. Some corporations do businesses under their names and also under separate business names, such as Alphabet Incorporation, which famously does businesses as Google. Limited Liability Company. The limited liability company is a corporate structure that protects its owners from being personally pursued for repayment of the company's debts or liabilities. Limited liability companies are hybrid entities that combine the characteristics of a corporation with those of partnerships. While the limited liability feature is similar to that of corporation, the availability of flow-through taxation to the members of an LLC is a feature of partnership rather than LLC. Companies are permitted under state statutes, and the regulations governing them vary per states to state. LLC owners are generally called members.
Good afternoon, everyone. I'm Roosevelt Alfanta. Today is we're going to report promissory notes. What is promissory notes? Number one is parties involved. The promissory notes identify the issuer, who owns the debts, and the payee, to whom the debt is owed. Number two is containing unconditionally undertaking. Number three is to pay a certain of money. Number four, only to order a certain person at the bearer of the instruments. Definitions. According to Section 4, a promissory note is an instrument in writing, not being a banknote or a currency note, containing unconditionally undertaking signed by the maker to pay a certain of money only to bearer of the instruments, structures of promissory notes. So a promissory note is referred to a note payable, and it is a legal document, more in particular financial instruments or debt instruments, which one party, the makers and the issuers. So promises in writing a note to pay determined sums of money under the specific money, like kaning like utang ka inana dapat na kay promissory notes. Structures of promissory notes like mauni suit sa atong promissory notes. Letter A, face value, amount of money borrow which is 10,000. And letter B, terms, length of time that money is borrow. For example, is nangutang ta karon which is 10 days na to impasod. So, date, the date that the note is issues, kung kano siya na siya na-aproban or na-permahan. The payee is the company extended the credits. GC equipments is mao ni sila ang nangutang. And the rate is the annual rates for the cost of borrowing the money. For example, is nangutang tag 10,000. So, magdepende na siya sa atong giutangan bilang ihatag nga interest. The maker is the company issued that the note are borrowing the money. So, money ang regular corporations ang nagpautang. So, maturity date is the date that the principals and the interest rate are due dates. So, ang kaniya is December 1, 2024 niya ipason. Like, 3 months niya ipason. These of a promissory notes. These are primary two parts involved in a promissory notes. They are the maker or the doer, the person who makes the notes and promise to pay amount stated in. So, mao sila ang naghimo sa promissory notes nga ila ihatag nimo. So, the payee, the person to whom the amount payable. So, kani ang payee is sila ang mobayad nga kana nga amount nga ilang giutang in that day nga gidal-an sila notes. So, this is essentials of promissory notes. In course of transferee of a promissory notes by paying others, the parties involved may be the endorser, the person who endorsed the notes favor of another person. Like sila ang musugot if magpa-transfer sila sa documents ngadto sa laing tao. Then the endorsee is the person in whose favor to note that negated by endorsement. Like mao ni sila ang mudawat sa mga document gikan sa endorser. So it must be in writing. A promissory note has to be in writing. An oral promise to pay does not become a promissory note. The writing may be on any paper or book. So illustrations assign that the instruments in the following terms. Example is I promise to pay B or order Rs 500. I acknowledge myself to be indebted to be in Rs 1000 to be paid on demand for a value period. So both the above instruments are valid promissory notes. Number 2. It must contain a promise or an undertaking to pay. Undertaking to pay may be gathered either from express words or by necessary implications. A mere acknowledgement or indebtedness is not a promissory note or true. It is a valid as an agreement and may be sure upon as a illustrations assign the instruments in the following terms. Mr. B, I own you to pay Rs 1,000. I am liable to pay B Rs 500. The above instruments are not promissory note as therein. So we are assigned the instrument in the following terms. The money ang example is I acknowledge myself to be indebted to be in Rs 1,000 to be paid on demand for value received. So money ang valid nga promissory notes. 3. It must be signed by the maker. It is imperative that the promissory note should be done and authentically by the signatures of the makers. Like dapat ang promissory notes is na yun na signature sa maker kay it is important. So signatures means the writing or otherwise affixing a person name on a mark to be present his name by himself or by his authority with the intentions of authenticating a documents. Like if ever is signature is not dito is pwede pud if kana nga person is authority na nimo nga mo Mupirma ang maker ana. 4. The promise to pay must be unconditionally. The promise to pay must not depend upon the happenings of some uncertain events, a contingency, or the fulfillment of a conditions. So here are illustrations and examples. I promise to pay B as Rs 500 7 days after my marriage, and I promise to pay Rs 500 as soon as I can. The above instruments are not valid promissory notes, as the payment is made depending upon happening of uncertain events which may never happen. As a result, the sums never become payable. For example is like mangutang ta sa atong classmate, nagmana ta nga pahulma ko da baby. Bayaran na ti ka ugma. So di na siya valid for promissory notes. The maker must be a certain person. The instrument must be itself indicate with a certainly who is the person or the person engaged himself or themselves to pay. Alternative promissories are not permitted in law because of the general law that we are liability lies on ambiguity must lie. The payee must be certain. Like the maker, the payee of a note must also be certain of that phase of the instruments. A note is a favor of fictitious person is a legal and void. A note made payable to the maker himself is a nullity, the reason being the same person is the both of promisor and the promises. The sums of payable must be certain. For a valid note, it is also essential that the sums of money promised to be payable must certain and defined. The amount payable must not be capable of contingents or additions or subtractions. For illustrations, I promise to pay Rs 500, first deducting their own any money which he may owe me. The above instruments are invalid as promissory notes because the exact amount to be paid is not certain. The amount payable must be illegal. A document containing a promise to pay a certain amount of foreign money or to deliver a certain quantity of goods is not a note. So the payable must be illegal, like non-judicial documents.
Good evening, ma'am. I'm Inocellas Clark, and this time I'm going to present my topic, and my topic is adjusting entry to adjust deferred income. First is the purpose of adjusting entries is to record the usage of assets or the expirations of the liabilities that have not been previously recorded, such as preferred expenses or accrued expenses. Second is comply with accounting principles, standards, and regulations to ensure the accuracy and consistency of financial statement. Next is define deferred income and its significance. The significance of deferred income lies in its impact financial reporting by deferring and recognition of revenue until the obligation are fulfilled. Companies can ensure accurate and transparent financial statement. It helps prevent the overstatement of revenue and provides a more realistic depiction of the company's financial performance. Next is adjusting entry process. First, the deferred income is recognized as revenue in the period it is earned or realized. This is done by debiting a deferred income account and crediting the corresponding revenue account. By doing so, the previously recorded liability is reduced and revenue is appropriately recognized. Second is overall the process of making adjusting entries for deferred income involves in recognizing the revenue and updating the financial statement to reflect the proper accounting treatment. Next is example scenario involving unearned revenue. Let's say the software company TICO signed a contract with a client to provide a one-year subscription to their cloud-based project management software. The client pays upfront for the entire year of service totaling $12,000. At the time of payment, TICO received the $12,000 from the client, but they have not yet provided the full year of service since the payment is received in advance. The $12,000 is considered unearned revenue for TICO. Over the course of the year, TICO gradually provides access to the software and support to the client. Each month, they recognize 1/12 of the total payment as revenue, which amount to $1,000. As each month passes, the unearned revenue decreases by $1,000 and the unearned revenue increases by the same amount. By the end of the year, TICO has provided the full year of service and the entire $12,000 has been recognized as revenue. The unearned revenue balance is reduced to zero, indicating that all revenue has been earned. Next, the debit and credit aspect of the entry. 1. Initial receipt of payment. Debit is cash bank account. Credit is unearned revenue. When the client pays upfront for the subscription service, TICOs receive the cash, which increases their cash or bank account balance. This is recorded as a debit to the cash bank account. At the same time, since the service is not yet provided, the payment is considered unearned revenue. Therefore, the entry includes a credit to the unearned revenue account, which increases the liability on TICO's balance sheet. Next is adjusting entries help provide a true and fair view of the company's financial position. 1. Matching principle. The matching principle states that the expenses should be recognized in the same period as the related revenue. Adjusting entries ensure that all relevant expenses are properly matched with the corresponding revenue, promoting a more accurate representation of the company's profitability for a given period. Second, completeness. Adjusting entries address any items that were omitted or accurately recorded during the initial transaction processing. By capturing these adjustments such as accrued revenues or expenses, prepaid expenses, or deferred revenue, the financial statements become more comprehensive and complete, providing a more accurate view of the company financial position. Next is the importance of proper accounting practices. Financial transparency and trust. Proper accounting practices establish transparency in financial reporting, enabling stakeholders to understand and access the financial position and performance of company. Transparent financial statements build trust among investors, creditors, and other stakeholders. First, fostering confidence in the organization, operations, and future prospects. Lastly, summary and conclusion. First is adjusting entries are crucial in financial reporting to ensure accurate recognition of revenue and expenses in the appropriate accounting periods following the matching principle. Second is they are essential for companies using accrual basis accounting as they captured accruals such as accrued revenue and expenses, ensuring financial statements reflect the economic reality of the business. And that's all. Thank you, everyone.
Good morning, everyone. We'll be talking about accounting adjusting process by Mr. Rizz Preacher. Accounting period concept. There's cash basis and accrual basis. Cash basis is revenues and expenses are reporting the income statement in the period in which cash is received. Accrual basis, revenues are reported in the income statement in the period that they are earned. Revenue recognition concept and matching concept. Adjusting process, and every adjustment affects one income statement account and one balance sheet account. The income statement account will be revenue or an expense. Adjustments are only done at the end of accounting period. Cash account is never adjusted. Accounts requiring adjustment. Prepaid deferred expenses. Initially recorded as assets but are expected to become expenses over time or operations. For example, muscles, supplies, and prepaid insurance. Accounts requiring adjustments. Unearned deferred revenues. Items recorded as liabilities but are expected to become revenues over time or through the normal operations of the business. Deposits by customers for work to be done in the future. For example, unearned rent. Accrued revenues. Some revenues are only recorded when cash is received. At the end of accounting period, there may be revenues earned but not recorded. Accrued expenses or accrued liabilities. Incurred expenses but not recorded. For example, mga wages payable. Supplies. For example, the general ledger shows a balance in the supplies account of $2,000. Inventory shows $500 of supplies still on hand. Supplies, ni-balance siya o $2,000, and then inventory, kimaynusan siya because used up becomes 1.5. So ang supplies expense kay $1,500. Next will be Joseph Ivan Amaba.
Hello everyone, I'm the next reporter. My topic is prepaid insurance. The GNL shows the balance are $6,000. The policy was purchased on May 1 for 12 months. Record the adjusting entry on December 31 for insurance expired. $6,000 to 12 months equals is $500 per month. May to December was 8 months times $500 equals $4,000 expired. Insurance expenses is $4,000 and the prepaid insurance is $4,000. Next slide. Deferred revenues or unearned revenues. Items initially recorded as liabilities but expected to become revenues over time. Example, unearned fees or liability account. Next slide. Next is unearned fees or revenue. GNL shows that the balance in the unearned fees account is $6,000. A review of the entries shows that the balance should be $2,000. So balance is $6,000 minus and should be $2,000. The fees earned is $4,000. Unearned fees is $4,000 and fees earned is $4,000. Next slide. Accrued expense. Expenses that have been incurred by have not been recorded in the accounts. Examples are wages. Next. Accrued wages. Wages are paid on the second and fourth Fridays for the 2 weeks period. Payments were $950 on December 13 and $950 on December 27. The wages for Monday through Thursday is $250. Record the wages due. The wages expenses is $250 and wages payable is $250. Next is accrued revenue. Revenues not billed to customers $2,500 and accounts receivable is $2,500 and fees earned is $2,500. Next is fixed assets. Physical resources that are owned by a business, and depreciation is a reduction in the value of an asset due to its use. Depreciation expense to 1 year reduction. And accumulation depreciation contra assets showing lifetime reductions. And credit is increases the account. Next. Next is the depreciation expense. Depreciation expense is $1,000 and accumulated depreciation is $1,000. Next is the book value. The cost of the asset and accumulated depreciation is it's all about book value. And the next is accounting cycle. First is adjusting entries are recorded in the journal. The second is posted to the general ledger. And the third is adjusted, the trial balance is prepared. The fourth is financial statements are prepared. So,
good day everyone. Today we're going to tackle about adjusting entry to the record depreciation expense. In adjusting entry to record depreciation expense, when fixed assets are acquired for use in a business, they are usually useful only for a limited period. The cost of these assets is allocated as an expense over the years they are used. This gradual conversion of an asset into an expense is known as depreciation. In other words, depreciation is allocation of the cost of a fixed assets to the period over which the benefit is obtained from the use of the assets. Depreciation is calculated on the original cost. Importantly, depreciation should not be confused with an asset's market value. Any decrease in the market value of an asset cannot be regarded as depreciation. So what is adjusting entry for depreciation expense? So an adjusting entry for depreciation expense is a journal entry made at the end of a period to reflect the expense in the income statement and the decrease in value of the fixed asset on the balance sheet. The entry generally involves debiting depreciation expense and crediting accumulated depreciation. In adjusting entry for this depreciation expense, the company debits the expense in the income statement and credits in associated accumulated depreciation in the balance sheet. The expense represents the decline in the value of the fixed assets over a period of time. The debit to the depreciation expense accounts will reduce net income on the income statement, while the credit to the accumulated depreciation account will reduce the book value of the fixed asset on the balance sheet. How is the depreciation expense calculated? The depreciation expense is calculated by multiplying the original cost of the fixed assets by the percentage of depreciation. For instance, if a company uses the straight line method of depreciation, it will allocate an equal amount of the cost of the fixed assets to each year of its useful life. Example, depreciation. To clarify the concept of depreciation, let's consider an example. A lorry costs $4,000 and will have a scrap value of $500 after continuous use of 10 years. This means that the cost of $3,500. So therefore, $4,000 minus $5,000 is to be allocated as an expense over 10 years. Accounting treatment of depreciation. The amount of depreciation charged on various assets is considered a business expense. At the same time, it is a reduction in the value of the particular assets upon which depreciation has been charged. Therefore, depreciation has the following two effects on final accounts. First, it is an expense of the business, therefore it is recorded on the debit side of the profit and loss account. Second, on the other hand, it is a reduction in the value of a particular assets, therefore it is deducted from the associated assets accounts in the balance sheet.
Adjusting entry. The adjusting entry for a depreciation expense involves debiting depreciation expense and crediting accumulated depreciation. What is shown below is an example of depreciation expense table. The depreciation expense appears on the income statement like any other expense. The accumulated depreciation is a contra asset account. It is shown as a deduction from the cost of the related asset in the balance sheet. Both of the presentation are illustrated in the following example. So this is the first example of adjusting entry. K&Co purchased furniture costing $2,500 on the 1st of January 2016. The furniture salvage value is 0, and it is decided to provide depreciation at 10% PA on the original cost. Required is make an adjusting entry for depreciation expense on 31st December 2016. Also, how will the purchase be shown as a fixed asset on the balance sheet on 31st December 2016 and 31st December 2017? So what is shown here on the right side is the solution of the adjusting entry for depreciation on 31st December 2016. So first the table is dinhaibotang ang date and a description, which is the depreciation expense furniture and the accumulated depreciation furniture, and then the amount sa ilahang bayron nun or the cost. And then the above adjusting entry will also be made at the end of the next 9 years. After that period, the furniture will be fully depreciated. So pag times ani niya kay 250 times 10 equals 2,500. So mao na siya ang purchase furniture costing sa K&Co. So sa ubos is the partial balance sheet as of 31st December 2016. So nakabutan diri kay furniture and less accumulated depreciation, which is 2,500 minus 250 equals to 2,250. So next is the partial balance sheet as of 31st December 2017. So the furniture minus less accumulated depreciation. So 2,500 minus 500 equals 2,000. So balance is accumulated depreciation account at December 31, 2017 is $250 plus $150 equals $500. So next is what are the effect of depreciation on the final accounts? Depreciation expense has two main effects on an organization financial statements. First, it is treated as an expense in the income statement, which reduces taxable income. Second is it is a reduction in the value of an asset on the balance sheet. This decrease in value is matched with an increase in accumulated depreciation, which provides a more accurate valuation of asset on the balance sheet. So next is what is the impact of depreciation on net? So depreciation expense reduces taxable income as it is an expense that is deducted from revenue. In other words, it reduces the amount of income that a company has to pay taxes on. This lowers the company's tax bill and increases its income. And then last is what is the impact of depreciation on cash flow? So depreciation expense does not have a direct impact on cash flow. However, it can indirectly impact cash flow by reducing taxable income and, as a result, lowering the amount of taxes that a company has to pay. This frees up cash that can be used for other purpose. That's all. Thank you.
Adjusting entry to take bad debts. So what is bad debt? When an account receivable becomes uncollectible, the entity sustained called bad debt loss. Or these are the amount na wala nagibaydan sa customers or kanang the amount which cannot be recovered from the debitors. So these are called bad debts. Two methods are followed in accounting for bad debt loss. The first one is the allowance method. The allowance method requires recognition of bad debt loss if the accounts are doubtful collections. When we say doubtful collection or doubtful debit, meaning katuning mga dili sure kung bayad ba sila sa sakto nga due date or katuning mga customer na kung kano sa sila ganahan mo bayad sa ilang account. The second one is direct write-off method. So, ang example ani is, in one accounting period, a company can experience large increases in their receivable account. Then, in the next accounting period, a lot of their customers go difficult on their paying or kanang dili sila mabaydan, thus making the company experience a decline in its net income. Therefore, pwede sila mogamit of direct write-off method, can only be appropriate for a small immaterial amounts. There are two methods used in estimating bad debt expense. The first one is percentage of sale. The second one is percentage of receivable. So the next reporter will be give the example and explain on how you get the amount.
Percentage of sales. Example. On March 31, 2017, Corporate Finance Institute reported net credit sales of $1,000 using the percentage of sales method. They estimated that 1% of their credit sales would be uncollectible. So how do we get the 10,000 amount? So the credit sales, which is the 1 million, and the percent of the credit sale is 1%. So ang 1 million is i-times siya sa 1%, equals to $10,000, which is the bad debt expense. The next method is the percentage of receivables. So here's the examples, and as you can see in this picture this is what we call aging schedule. So there are customers which are AJ Hansen, Carlson, Bulk Shelf Academy, and the last one is ACZ Institute. So, nanin sila utang. Si AJ Hansen is $600 and Carlson is $250. Si Bulk Shelf is $1,500 and kang ACZ Institute is $980. So, let's start to AJ Hansen. Si AJ Hansen is wala siya nakabayad sa date nga bayadanan. And so nibayad siya sa sud sa 1 to 30 days is $300. And there are estimated percentage uncollectible ani, which is the 4%. So to have the estimated bad debits is ang $300 is gitimes siya sa 4% equals to $12. And so let's proceed to 31 to 60 days. So si Mr. A.G. Hamson is nibayad na sad siya og $200 and there are estimated percentage uncollectible which is the 15%. So to have the estimated bad debits is ang 200 and ang 15% is multiply na sad siya equals to $30. And sa sud sa 61 to 90 days is si AZ Institute is nibayad og $980 and there are estimated 2% uncollectible which is the 25%. So to have estimated bad debits is multiply ang $980 times 25% equals to $245. So to have the total estimated bad debits is i-add na to ang $50 plus $245 plus $30 plus $12 plus $35 equals to $372. So that's the total estimated bad debits.
So that would be all for our report about adjusting entry to take up bad debits.
Hi, good evening everyone. My name is Cal Marie Dizan from BSHM 1-1 and today I'm gonna tackle about the preparation of worksheet. By the way, what is worksheet? Multiple column sheets wherein all necessary information used for the preparation of the financial statement is recorded in a systematic process is called a worksheet. The worksheet is not a permanent account, it is not a part of a journal or ledger, it is a device used for easy preparation of adjusting entries and financial statements. The worksheet is a multi-column sheet or a computer spreadsheet where the account writes in brief information necessary for the preparation of adjusting entries and financial statements. There are three types of worksheets. First, we have the general worksheet. The general worksheet contains 4 to 6 pairs of columns. Generally, 5 pair columns or 10 columns worksheets can serve the purpose of general business. These 5 pair columns are trial balance, adjustment, adjusted trial balance and income statement, and lastly, the balance sheet. The second one is the detailed worksheet. The detailed worksheet is prepared for containing more detailed information over general worksheet. The matters for which item-wise lists are to be prepared are accounts receivable and accounts payable list. The second one is the production expenditure list, and the third one is the insurance premium list, and etc. The third one is the audit worksheet. Audit worksheet is used for preparing financial statements and lists for various uses of business concerns. The audit worksheet is prepared in the light of the auditing of various items included in the worksheet. It is an aid to audit the work of a business concern. The worksheet is a technique of accounting through which the accounting information is integrated for adjustment and classification. The 8 steps of preparing accounting worksheet. The first one is name of business organization and preparation date. At the beginning of the worksheet, the name of the organization for which worksheet is prepared is to be written in the bold form, and also the date of preparation of the worksheet is to be mentioned. The second one is drawing column and mentioning the head of the column. The third one is an adjusted trial balance. This trial balance is called pre-closing trial balance as it is prepared with the ledger balances before keeping accounts of adjustment items. Debit and credit balances of ledger accounts are written in the debit and the credit columns of the trial balance respectively. The fifth one is the adjusted trial balance column. To identify the adjusting items, separate code numbers for each item be given in debit and credit columns. Thereafter, debit and credit columns of adjusting are totaled for assuring their agreement. The sixth one is income statement column. All periodical expenses and incomes of adjusted trial balance are written in debit and credit column of income statement respectively. The difference between total income and total expenses of the income statement is called profit or loss. The profit or loss of income statement is transferred to the balance sheet if the retained earnings statement is not prepared. Retained earnings statement. In the case of a joint stock company, the retained earning column is kept in the worksheet before the balance sheet column. Here, previous year's profit, loss if any, and income loss of income statement of the worksheet are written in the credit company column, and distribution of items regarding distribution of profits such as dividend paid, proposed dividend, income tax paid, recreation of fund are shown in the debit money column of retained earnings statement. Lastly, we have the balance sheet. All assets and liabilities of adjusted trial balance, including the balance of income statement, retained earnings statement, are written in the debit and credit columns of the balance sheet of worksheet. Assets are written in the debit money columns and liabilities owners' equity are written in the credit company column. Therefore, worksheet is important because it simplifies the work to be done at the end of the accounting period. Worksheets help to avoid the entering errors in the permanent record of accounting. If an error is made on the worksheet, it can be corrected easily.
So good day everyone, I am Nikki Raya and today I'll be discussing about what are financial statements. So financial statements are a set of documents that shows your company's financial status at a specific point in time. They include key data on what your company owns and owes and how much money it has made and spent. So there are four main financial statements. First is balance sheet, second is income statements, third is cash flow statements, and the fourth is statements of retained earnings. So first is balance sheet. The balance sheet shows that what the company owns and how much it owes at the end of the period. It is based on the equation. It's like asset equals liabilities and plus shareholders. So in other hand, it provides company's financial position and helps investors and analysis understand in liquidity, solvency, and capital structure. So here is the example of balance sheet. As you can see, it has current assets, fixed assets, and then current liabilities and long-term liabilities. So next is income statements. And income statements shows the profitability of your business. It details how much money your business earned and spent. The income statements is also sometimes referred to as a profit loss statements or an earning statements. And it also known as the profit and loss statements shows the company revenues and expenses over a specific period of time, such as a month, quarter, or year. It helps investors and analysis understands the company profitability and financial performance. It shows revenue from selling products or services, expenses of generates the revenue and manage your business. Next is income, net income or profit that remains after your expenses. So this is an example of income statements, as you can see. And also it has operating expenses and earning before interest and taxes. Next is cash flow. Cash flow statement, sometimes called a statement of changes in financial position, shows how money has moved through your business during the period. It shows a company's cash inflows and outflows over a specific period of time, such as a month, quarter, or year. It helps investors and analysts understand companies' ability to generate cash and manage its cash. And lastly is that statements of retained earnings shows that the accumulated earnings of the business after any dividends or distribution to shareholders. As well, this statement sometimes could a statement of changes in equity. Also shows that the change in the retained earnings account between the opening and closing periods of each balance sheet. So, statements of retained earnings is and also known as statements of retained earnings shows that changes in the company equity over a specific period of time. It helps investors and analysts understand how companies' earnings, dividends, and stocks or purchases affect in equity. And together, these financial statements provide a comprehensive view of a company's financial performance, positions, and cash flows. And that's all. Thank you. Thank you for your listening.